Here is a trick that is encouraged in Glo-Bus, but not in the real world. Buy low and sell high. That's how you make money playing the stock market. But coach, I don't have control which way the market will price my Glo-Bus company in the future. Ah, my friend, but you are the company owner, so in fact, you do have some influence. And thanks to the Glo-Bus theory of efficient markets, stock price is very predictable. That's great. What do you need? For this advanced strategy, you will need a good understanding of the finance and cash flow page and a basic understanding of the R&D page, also found in these two videos here. But I will summarize the essentials in this video now. For our purposes, on the finance and cash flow page, cash in is when your company sells stock. Cash out is when your company buys or repurchases stock, buy and sell. Research and development is something you invest earnings per share in during the early years and try to have a payout of earnings per share in later years, thanks to that investment. So how do you cause the price to go up or down, especially without hurting your company? And what makes stock prices go up anyways? From the participant's guide, we quote, "Stock price is a function of revenue growth, earnings per share growth, average ROE, credit rating, and the rate of growth in the annual dividends and score." So the technique of pump and dump is as follows. First, hold these constant: revenue growth, ROE growth, credit rating growth. Next, change R&D in big jumps to control earnings per share and score, which in turn manipulates the stock price in the current year. This is simpler than you might think. If you want your stock price to go up, go from max R&D to zero R&D in that year. At the same time, you buy back as many shares as you can in that current year. The next year, you can sell those same shares you repurchased for a profit, and the amount that you make is the difference between these two prices. You can do the same thing going down. If you want your stock price to go down and go from zero R&D to the maximum R&D during that year, sell as many shares as you like in the current year. And then next year, you can buy back those same shares you sold for a profit. Again, the amount that you make is the difference between the two prices. Now, this is an advanced strategy, so it comes with some warnings. Number one, hold revenue growth, ROE growth constant. But this doesn't mean that you can't grow at a high rate. It just means that for the duration of your stock price manipulating, you need to hold the rate of growth constant, not the net revenue. Number two, watch out for board of directors share sale and repurchase limits. They're found in the fine print below the stock issue and repurchase decision boxes. They are not equal. Don't sell more shares in the first year than your board of directors will allow you to buy in the next year. The third and final warning, don't expect to get the maximum profit out of your manipulations. The Glo-Bus creators are smart. They wanted this game to be like the real world. They even baked the well-known trading misery of slippage into their game. To avoid this problem, don't rely on little moves in R&D to move your stock price significantly. Only do really big moves in R&D, and consequently, EPS and score will make that stock price change. Those Glo-Bus creators are smart. To summarize the pump and dump advanced strategy, at constant growth rates, a big increase in your R&D will make your stock price go down, and to summarize the pump and dump advanced strategy, at constant growth rates, a big increase in your R&D will make your stock price go down, and a big decrease in your R&D will make stock price go up. Buy low and sell high to make a profit. If you like this content, please like it or post a comment below. If you want a Glo-Bus forecasting sheet to fill the red numbers at the bottom of the marketing pages, subscribe and then hit the link in the description.